Yeah, hi. A very good afternoon to everyone from sunny Singapore. Thank you for joining us today for Silverdale Fund's Global Quarterly Review Call September 2022. And my name is Dan Chen, and I'm part of Silverdale Investor Relations team, and I'll be moderating the quarterly review call today. Before we begin, just some housekeeping. There will be a Q&A session at the end of the presentation. So if you have any questions in between, feel free to leave them in the chat box. So just a recap of the September 2022 quarter. It started on an optimistic note with peak rates coming down in July 2022. However, the hawkish statement by Chairman Powell at the Jackson Hole Symposium on the 25th August spooked the markets, detracting markets from their performance. And before the markets could digest the higher for longer narrative, the UK mocked the global markets with a profligate mini budget, increasing the UK fiscal deficit by around 280%. Consequently, this resulted in one of the worst weekly returns for almost all asset classes in the past 50 plus years towards the end of the quarter. In such difficult market conditions of Q3 2022, Silverdale Bond Fund portfolio was down by negative 2.15%. After leverage costs and expenses, it delivered negative 6.35% as against the Bloomberg Emerging Market Asia Corporate Corp Index of negative 5.2%. During the quarter, the fund also paid its 30th quarterly dividend of $2.10 per share, taking the total dividend paid on the fund for the trailing 12 months to $8.40 per share. May I now request our CIO, Mr. Sanjay Guglani, to take us through the performance of Silverdale Bond Fund and how the fund is positioned in this current environment. Over to you, Sanjay.
Okay. Can you see the presentation?
Yes, we can.
Wonderful. So good day to my fellow stakeholders. It is always a privilege to address you all. And as always, we would be more than delighted to take your queries set out there and to be able to explain to you in terms of what we have done, what we plan to do, and how these extraordinary times could result in extraordinary gains going forward. So on that note, let me quickly take you to the fixed income outlook as we see at Silverdale. So as my colleague Dandy had told, so we started the quarter on an optimistic note. We saw the peak rates actually dropping down from 3.48% in June end to 3.31% by July. However, on 25th of August, Chairman Powell at Jackson Hole spooked the party by insisting on the rates stroke inflation being higher for longer. And that's exactly what you see happening across out there. At the first instant, the Fed peak rate coming down and suddenly spiking up across out there. If that wasn't bad enough, we had the August CPI numbers, which were worse than what was expected. We were expecting around 8.1, came out 8.3. But what happened, which other Rogers and market, I would say, was the UK mini budget that led a financial tsunami, and I will talk about it in a few slides from now. The first and foremost is that the higher for longer, what does it mean and why is it so? The reason is, of course, because of inflation. The good news, the headline inflation is indeed coming down. But the problem is in terms of the core inflation, which actually is going up. Not only is going up, the reason why it's going up is critically important, which is that it's going up because of the sticky factors the persistent factors of transitory factors of the core inflation actually have come down very, very sharply, as you noticed. But this is what is the core problem of the economy. Now, when we talk about the sticky portion of core inflation, one of the biggest contributor to it is shelter. Now, shelter is with the way the US computes shelter or rent, as we call in the rest of the world, is a bit funny. And the reason it's a bit funny is because approximately 72% of respondents are actually property owners. And the question they ask is, at what rent will you give your property on a bare basis? Interestingly, what we have found out is that the expectation of rent has a very high correlation with the mortgage rates. Now, as we all know, the mortgage rates in US have hit the historic high of 6.75%. As a matter of fact, briefly even crossed 7%. Not surprisingly then, the mortgage applications have dropped and they actually come down by almost 40% from the peak, which in that sense of the word is a good news. Because when the mortgage rates goes too high, there's less affordability of buying new houses and the property prices come down. What has indeed happened is that we have seen one of the sharpest fall in the property prices in the US in the past 11 years. This is very much comparable to what happened in 2008. Hence, we expect the feedback loop to the feeding into the lower rental faster than normal, about 8 to 10 months. The other key aspect of the inflation, of course, is the consumer demand. Talking about consumer demand, the key thing, of course, is in terms of the job openings. As we all know, the job openings have been almost 2 times what is the amount of people available for working. But as you notice, this has come down, and most importantly, it has come down very sharply in the last month and so. So today we have about 1.67 jobs for each person willing to work. Lower than 2, which was a peak post-COVID, but much higher than normal, which should be marginally above 1. Which basically means that if you look in the big picture, the trajectory of inflation has been on the expected lines till UK spooked the market. The UK's profligate mini budget increased the fiscal deficit to almost 5.3%. What it basically means is that UK will now need to borrow about $190 billion. To give a color to you, this is one of the highest ever borrowing the United Kingdom has ever done or shall do, and very much comparable to what happened in World War II, the previous financial crisis, and the COVID times. This huge spike in terms of borrowing would obviously lead to a very, very, very sharp drop in the risk-free rate, the risk-free securities of UK called gilts. The 30-year gilt dropped by almost 30%. And whatever you saw the interest rate coming down for the last 20 years got nullified across the board in a matter of few weeks to 2 months. The situation became so bad that we could see the trembles across the board. So we saw, for example, in terms of the UK Treasury, you look how spread is went. It also resulted, of course, US Treasury, German bonds. Till, of course, the Bank of England had to step in and give an emergency quantitative easing, so to say, buyback of bonds to be more precise. which to some extent contained the market. But to give a color to you, this 16% decline of the US aggregate bonds is the longest and the largest fall ever in the history of US bond markets. So to summarize, the quarter began at a reasonably good note. Jackson Hole put a spook the story, and of course UK torpedoed the whole edifice altogether. So when you look at performance of a fund, you will see the same thing, that for the first 2 months of the quarter, we actually did pretty well. We among the top performing funds as usual. But come September, the whole story basically had a tailspin across the board, and Silverdale was not an exception to it. And our fall was very much in line with the market fall across of that. Having said that, even before I go detail into our presentation, I want to highlight a very important portion. Yes, the market has reacted, or I would rather say overreacted, which is normal thing to happen in the extreme ends of the market. But if you look in terms of fundamentals, the fundamentals continue to be very robust. In particular, the consumer balance sheet continues to be very, very strong, thanks to the excessive savings during the pandemic. So as you know, there were two key handouts in the pandemic in US. They led to huge amount of excess saving. These savings are about $2.6 trillion, approximately 11% of the nominal GDP of US. The key takeaway from that is that we do not expect the demand to come down anytime too soon. Even in terms of the banking sector has huge amount of reserves. That is, they have a high ability to even lend monies. And I wanted to highlight, for example, the graphics on the screen, which talks about the buffer to 81 trigger. And you will notice even the so-called not so healthy banks like Deutsche, it has a trigger amount of 28 billion euros. Credit Agricole, 62 billion euros. So the key takeaway to you is the cushions which the banking sector has is very robust, including the corporates now. Corporates wise, again, most of the corporates have very much manageable debt ratios. As you know, the default rate in IG has been zero, including the COVID and post-COVID China sector out there. That shows the strength of the IG sector. But I also want to highlight, even in case of high yield, look at the beautiful ratios they're getting with it. The interest coverage ratio has actually jumped. What has happened is very important. So what has happened is that most of the corporates have been able to use the window of low cost borrowing in order to increase the maturity of their borrowings. And of course, lower the cost of the balance sheet borrowing itself. So when you look at it, both has happened. We have seen that both the gross and net leverage coming down, and of course, the cost of borrowing itself coming down. And that's the opportunity. See, it's very easy to get carried away with the mini budgets of UK's and this moment, that moment. But coming to the fundamentals, what you will notice is the default rate continues to be very, very low. So you look in terms of IG, is close to zero. Even if you look at a high yield, they're much, much lower than the average. We're talking about default rate of IG to be less than 2% when the historic average has been 5%. So what is happening in turn for an investor like you is that you are getting the returns which are comparable to the average returns over a long period of time, very, very robust returns. So we're talking almost about 5-6% return on a long-term average basis. But default rates are only about 1/3. And that's an exceedingly attractive opportunity for a disciplined investor. As I mentioned to you, the IG continues to be very robust. Again, even if you look in terms of high yield, whenever we see the spreads being higher than 500 bips, we historically have got about 10.5% return. And this is very important to keep in mind, that the returns you're getting today are significantly higher than the comparable risk in the market. Before I conclude this section, I just want to highlight one point, and which is, why is it so? Answer: the reason it is so is because the Fed rate currently are much higher than the long-term equilibrium rate. This is the core. Since the long-term equilibrium rate continue to be about 2.5, and just remind you, they have been there for many decades. What it basically means is that current excessive return you're getting is only a short-term phenomenon. Not too short, I mean like a couple of years sort of situation. With that backdrop, let me come to the core performance of the Silverdale bond fund. As a highlight, the portfolio return for the quarter had been about -2%, which compares very well with the emerging market 1 to 3 year index, which is down by about 1.6%, and Bloomberg Emerging Market Asia Credit Corp Index, which was down by about 5%. Post leverage expense and cost, we were down by about 6%, very much in line in the short term. Because of that, and in long term, as you know, we have very significantly outperformed the indices. Importantly, I also want to assure my fellow stakeholders that there is no strategy drift. We are being focusing on what we do best, which is in terms of looking up the bottoms up analysis and being disciplined in terms of what we do. We continue to be well diversified. We continue to maintain high quality portfolio. And as I shared you, about 77% of portfolio continues to be investment grade, and we continue to be short duration. And this is one of the key reasons why our fall has been much lower than the index on an unleveraged basis. From the long-term investors of Silverdale Bond Fund point of view, we continue to maintain our dividend of $2.10 every quarter, which is $8.40 per annum. As we all know, the only mantra for long-term wealth creation is in terms of good carry, and I can assure you that we have a very, very attractive carry at this point of time. In particular, so when you talk about the performance, the Q-on-Q performance wise, we have given you, as I mentioned to you, about -2% at portfolio return and -6% at the fund level returns sector out there. This is after paying you dividend of $2.10. From the -6% return, the return, almost 8% return is attributable to the mark-to-market drop in the bonds following the increase in the Fed rate expectations, and the carry is about 2%, taking the net return to be -6%. And as I mentioned earlier, we continue to pay you $2.10 as dividend for the quarter, which incidentally is 11% yield, which is the highest in the history of Silverdale. In terms of trailing 12 months, we have been down about 25%. And again, it's primarily because 1/3 of about 33% approximately of the fall is because of the M2M losses, and about 7.5% has been because of the high carry, resulting in 25% total return there. We paid you $8.40 as dividend in the trailing 12 months. In terms of quality, we have maintained the quality as you last quarter. Also, we were 77% IG. I want to once again highlight to you that unlike most other funds, when we talk about IG, we talk about IG as validated by S&P, Moody's, or Fitch only, and not internal ratings. Very, very important ring of assurance for our investors. In terms of duration, we are continuing to short duration. Our duration marginally come down from 1.8 to 1.6 years. We would be increasing duration, but we are not in a hurry to increase duration right now. And once we see the Fed rate peaking out, which should be happening in around Q1, Q2, around that level, we would be able to garner even further and better returns as we go further. And since we have marginally reduced the duration, so what you have seen is that the amount of the bonds having duration of less than 2 years is almost 70%, which is fabulous because it gives us opportunity to reinvest at the increasing yields which we are getting in the market. And very, very importantly, it also helps us to do two things. A, to avoid any fire sale because we have good headroom and further cash. And number two is that because we have always sufficient cash and more cash comes on to us, we can be opportunistic about investing. So when you see excessive headroom in our portfolio, rest assured that we are acutely aware of it, and we have kept it there as a dry gunpowder to fire whenever we see dislocations, and we do act on it and capitalize some extra alpha for our fellow stakeholders. In terms of the diversification, we continue to have 100+ securities in the portfolio across 23 countries on that. And in terms of change across the board, not much change. China has largely come down. And again, as you know, since the Q4 of 2020, we have not been increasing the exposure to China. And whatever is maturing, of course, we replace something else. So by default, China exposure has come down. We are fully cognizant that China gives very interesting investment opportunities. We are aware of it. We are keeping close track of it, and we would be able to increase exposure opportunistically, but we shall be always very cautious. So at this point in time, we would wait a bit before we will be increasing stake there. In terms of all the countries, as you notice, they have been very much close to what they were earlier. No major change in the things sector out there. The others, which always people ask, so highlight upfront, the others consist of 14 countries. Each of them has about 2.5% exposure. And these countries include Saudi Arabia, Germany, Singapore, South Africa, Cambodia, Australia, Switzerland, Morocco, Brazil, Russia, Netherlands, Korea, Luxembourg, and Japan. So again, to highlight to you, is extremely well diversified portfolio. In terms of performance, as I mentioned to you, we have been our performance has been in line with the market. Since our start of the fund, we have given about 2.6% return as compared to index, which is giving about 1.7% return. More importantly, if you look from the Sharpe ratio point of view, our Sharpe ratio is -2 as compared to index, which is about -4. What it means for you is you're getting almost 50% higher return for almost 50% lower risk which you're taking. From the short-term point of view, yes, there is a mark-to-market loss, but if there were to be mean reversion, which we know in long term it always happens, we have a very long potential uptick available to our investors. And also want to highlight, as compared to other funds, again, we have done better than many of the funds in the market. Coming to the specific quarter versus the year. So as you notice that we are quite in the middle of the league across up there in terms of performance for the year as well as for the quarter across up there. If you recall in my previous quarter presentation, as I mentioned to you, when our markets stabilize and start to become better, we tend to start to outperform given the embedded leverage which we have. The message to you is that despite the leverage, we are in line with the market, which basically means that when the market looks up, we hopefully will be able to give you a much better return. In terms of consistency of return, as I always maintain that the only thing which an investor can do is to ensure to invest into fund which is consistent in performance. And from that point of view, we have been very consistent in the performance. We are over 63% of months, we are giving you a positive return, which is fabulous because as you know, many of the funds give you around 53 to 58% positive returns. So we've been much more consistent than most funds on the street. Since our inception, we are giving you 26% return to you. At the current juncture, our yields continue to be much higher, in fact, it's historic higher, including higher than the COVID times. So that shows that there's huge potential in terms of upside across out there. So we are being able to capture the higher yields prevailing in the market and not being caught in terms of being stuck with long dated bonds. So that's been a very unique thing, which I'm sure you will appreciate in the coming quarters. And as always, during the entire period, we have maintained the dividend for our long-term investors. So at least while we are managing the portfolio, the cash flow is not impaired by any standards. As you know, we are most proud of our risk management protocols, and we are using Broadridge Clearstream Sentry risk management tools sector to manage it out there. We are in the process of further enhancing it, and I'll be sharing with you in the next quarter. So in summary, what I'm talking to you is that the current elevated yield is a friend of investor, is a foe of a speculator. From a medium to long-term point of view, it's brilliant return because it gives you high potential return in the coming quarters. Yes, there has been mark-to-market loss, but it has been more because of broad-based reasons. I want to confirm to you that we have 0 fire sales in the history of Silverdale, including last quarter. I repeat, we had 0 fire sales in the September 2022 quarter. And of course, there was no margin call. We continue to be high quality portfolio with 75% IG, short duration less than 2 years, only 1.6 years currently, with well diversified across 100+ bonds. In the performance, on a NAV to NAV basis, we are down by about 6%, as the index is down by about 5%, and other funds which down between 5 to 10% across the board. The most important thing which I want to highlight to you is that the current yields are elevated, which gives you huge potential returns, which, as you will see, will utilize very soon, given as I showed you the graphic to you, that we are looking into peak rates being already affected the market around 4.5. Takeaway to you is that the current market provides you huge opportunities across the board, and of course it's brilliant absolutely in terms of segment which we focus upon, which is the middle to left of the screen in front of you. Before I end, 2 last points. Second last point is that for people those who are concerned about recession, yes, there could be potential recession, but given what I discussed with you in terms of the balance sheets of the consumers, of the corporates in the banking sector, the default rates are likely to be very high. Having said that, what we have also seen is that 6 months before the recession and 12 months after the onset of recession, the best performing asset class is indeed fixed income. So this is something which I want you to note very, very well, that this is the best place to be. I would also give you a mirror image of it, which is that what we have seen traditionally is when you see the bond yields to be higher than the earnings of the S&P 500 companies, then typically bond tend to outperform it. So from that point of view, again, it's a fantastic asset class to consider in the current situation. And last but not the least, for people who are still concerned about it, they may very well consider locking in the returns by doing fixed tenor funds or something like that. So with that, thank you very much for being with us, for your support. In particular, we thank all the institutions that subscribe to us, the platforms which have been supporting our funds, and the various databases which carry our performance. I'm also grateful to my team who has been serving you very well in terms of all the client queries out there. These are some of the other funds which we are managing out there. The more popular, of course, have been the fixed maturity funds, and this is the performance of the basic fixed maturity funds in terms of the year-to-date performance as on September 2022. For further details, of course, my colleagues will be more than delighted to take queries around. On that note, thank you very much and happy to take any questions you might have.
Thank you, Sanjay. So we'll now begin the Q&A session. So if anyone have any questions, feel free to leave them in the chat box, or you can use the raise hand feature and I can call upon you to ask your questions.
Okay, so I have one question which says, what do you think of the effects of war and higher commodity prices on the bond portfolio? Okay, it's slightly embarrassing. Okay, so the embarrassing question is this: wars are good for the stock markets, sadly, but true. So if you see historically, whenever there is a war, subsequent to it, or even during the wartime, the markets do very, very well. And the reason is because it typically leads to a very high spike in the demand. And that's typically good for the people who's not in the war, sadly, but that's true. But the key problem is not war. The key problem is the collateral damage which comes with the war. And in this case, for example, in terms of Russia-Ukraine conflict, which we are talking about, the key problem has been in terms of energy. And you know, energy cost has gone up through the roof. There's no short-term solution to it. Yes, US is supporting the market in terms of releasing oil from the strategic reserves, but as we know, their commitment is until October end, which is this month end. That is when they could technically stop, and between you and me, I think they would stop in terms of releasing more oil, simply because the rate at which they are releasing oil, US strategic reserves will become close to zero in about 12 months, and I'm sure they would not ever want to do that. So there are implications there. Now comes to the second portion of the question, which is that on the bond portfolio. So again, it's idiosyncratic. For example, when you talk about companies like Vedanta, those bonds looks very interesting at the current levels set out there, or say for the same matter in terms of Daros and Indicas and all those producers of energy stock commodities. So it is very idiosyncratic. We have to always be careful of the issuers who cannot pass on the energy cost to the consumer. And to that regard, we have been careful in terms of not to increase our exposure to Europe, in fact, decreasing our exposure to Europe, because they are the worst sufferer in terms of energy cost. So next question I have been asked: what is the expectation for rent levels next year and why? Okay, so as I mentioned to you, the rent typically takes about 8 months to 12 months for them to adjust. So on the upside and downside, both sides. So because the current tenants are locked in, and the landlord cannot kick the tenant out and increase the rent, and vice versa. So what happens is this: when the property prices go up, the rent follow in close tandem, but take a lag of 6 to 8 months. And likewise, when property prices come off, it will take a bit of time before the rental will come down. So the big picture is that no, we don't expect the rent to come down in the next 6 to 8 months, but they will definitely come down. The only caveat I want to highlight to you is, as I mentioned to you in my presentation, that this time the drop in the property prices has been sharpest ever we have seen last 11 years, which is in that sense good, because it means the market readjusting much faster than it would normally do. If there are not risks in the portfolio of downgrades from IG to high yield with institutional investor exiting triple Bs, is there not a risk in the portfolio of downgrades from IG to high yield with institutional investor exiting triple Bs? Okay, let me say different. So the key point is that, are we seeing downgrades? Answer is no, we are not seeing downgrades. And and in terms of the space or the pace which you would have typically normally expected, no, so we are not seeing downgrades having much. Let me see if I can get you some graphic for that. But the key point is no, we are not expecting downgrades happening over there. What we are also seeing is, in certain cases, Genco being one of the examples of it, we are seeing some upgrades too. So on a totality basis, no, not we are much seeing a sector out there. Second, institutional investor exiting triple Bs. Not very sure. Again, what we have indeed seen is that the institutional allocation to fixed income has increased, and very specifically is increased for two segments of the institutional investors. Number one, with the large investors, which have a book of 100 billion plus, and number two, from insurance companies. So there are two segments where we say distinct increase in the allocation to fixed income. For others, it's still a mixed bag across there. Then the question they were asked is in terms of what are the expectation in terms of Q4. So as I mentioned to you, like market has already priced in almost 4.5% as a peak Fed rates. As well, it touched almost 4.7 and now about 4.3, which instantly is marginally higher than what is warranted in the current situations. You know, as they quote Lord Keynes, you know, the facts change, people have to change. But broadly speaking, I think we are very close to have hit the peak, and we're also seeing certain markers. I shared with you two key markers. One marker was in terms of the jobs openings, and second marker which I shared with you was in terms of the property prices coming down. So what we are already seeing, we are seeing key markers, and which is not entirely unsurprising. I'll show you once again so that we are on the same page. So this is the first marker I'm referring to. So if you look in terms of the property prices, on a highest drop in 11 years, and we are seeing in terms of the job openings, a very sharp drop. So almost from 12 million to 10 million, 2 million drop in the openings. Yet very high. Let me not get carried away with it. It's still very high, but yes, we are seeing certain markers out there. So on that basis, what we see in the market, for example, in terms of Bank of Australia increasing the interest rate by 0.25% instead of 0.5%, where you're talking in terms of the Fed governors giving some dovish comments. So it quite some seems that we are very close to the peak already done, if not already done across there. From that point of view, given that we're talking about a carry of roughly about 17-18%, you can take a quarter of it approximately happening as soon as the market bottoms up is out there. Please elaborate on trade movement of underlying paper in the last 2 quarters. Have we seen downgrades? How much? Nothing significant to write home about. Let me highlight one very important question to you. A lot of people think that downgrade is bad news, and it is indeed bad news for most of the cases, but not all the cases. So what happens is very important. So in certain cases, we know that particular bond will be downgraded. And once it gets downgraded, of course, there's a large chunk of investors who may not be able to hold them, and they will come and sell. So what happens is that the bond prices come down, so the yields go up even before they're getting downgraded. And more often than not, and it's statistically proven, so when they actually get downgraded, there's a marginal price appreciation. So it's not necessary the downgrades will be hitting your NAV because of that. The downgrade will hit your NAV when the person thought it would be IG and therefore paid the yields of an IG and then gets downgraded. So it's kind of a general brush sector there. But two takeaways to you. Number one takeaway is no, there was no broad brush downgrades happening left, right, and center. Yes, like typically 3-4 companies they could have downgraded because of that. We'll have people companies upgraded soon. That one or two companies up and down will be the impact. Nothing much to write home about. The next question is this is an interesting question. So I say, how much would be the impact if the IG bonds start to default going further? Very interesting question, because I want to highlight this. So the default rate in IG bond is 0 and has been 0 for quite some time. And at 0 is much below the typical average, which is about 0.2. So from that 0.2 being 0 for longest period of time, it is in the sense of the word quite comforting. But more importantly is this: IG bond defaulting is extremely rare. The number of times that IG bond defaulted in the world, I could count on my 10 fingers. What indeed happens is the IG becomes high yield and then defaults. Right? So the high yield default rate are slightly more representative in terms of what default rate talking about. And as I mentioned to you in my presentation, the default rate of the high yield, and that's the reason why I actually picked high yield, is much lower than typically you would see in long-term average point of view. So we are talking about less than 2% as compared to 5% long-term average default rate. So here is the IG default rate, and here is your high yield default rate. And as you see, both of them are much below the long-term average. And importantly, you look at this, the yield to worst is very much comparable to average. And as I mentioned in my presentation, default rate only 1/3 of what it would be. So God forbid, but even if there's a small increase in the default rate, it doesn't change the picture. And just to give a color to you, so in terms of high yield, and I'm side digressing topic, and so I will not like to go much into it, the majority of default come from the triple C. Triple C is where we are actually seeing much sharper increase in distress levels. But if I exclude the triple C, in case of single Bs, no, we are not seeing anything dramatic there happening. It's still downtick, nothing. Coming to double B, no, double B is perfectly fine. So long way to go before we talk about default into IG. Practically speaking, I don't think this will happen any day, any time in near couple of years for the matter. How is the China market movement affecting the portfolio? More and more news are coming from China after Evergrande demolitions, etc. So in the near future, are you expecting more upsets from China, which can hurt the SDA portfolio? Okay, China, of course, is something which you're watching very closely. In terms of the steps taken by the Chinese government, they've taken huge amount of steps. They're coming huge amount of stimuli in terms of backstopping the property market and spurring the economy by itself. They have reduced the interest rate, they have reduced the reserve requirement, they have reduced the down payment for mortgage, they have allowed more amount of houses to be bought to sit out there. So lots of positivities coming from China. The biggest problem in China is actually the lockdowns. Nothing else. The lockdown is a key constraint in terms of what we see. And while it's difficult to know when China will really open, there are a lot of rumors which come as early as November. We keep our finger crossed, but as I already mentioned, hope is not a strategy. We're not banking on it. Once we see it happening, of course, we'll bank up. We will be able to capitalize on it. So two portions of question. Number one is that, is it impacting the portfolio? Yes, it is impacting the portfolio. It would, you have 11% into it that we can't get impacted by it. But no, it's not something which is a majority or material thing which we need to really worry about in China. In particular, I should remind you once again that our exposure to China real estate property is less than 2%, and there's no reason for us to increase, and we will not increase the exposure whatsoever. Number two is that your second portion of question is that do you expect more upsets from China? The answer is no. We don't expect anything dramatic or drastic happening from China in terms of bad terms. Yes, if it opens up, if they get vaccination, that would indeed be a very big game changer. Do you see widening of inversion of 10-year yield should the Fed funds hit 4.25 to 4.5 by end of year? Okay, first is that 4.5% by end of the year looked to be too aggressive. I'm not sure, that's something which it could happen. And current circumstances where we have more than a couple of the Fed governors giving dovish signals, I don't think it should be concerned. But coming to a key question in terms of inversion of 10 years, we already seeing a certain of inversion across of that. But let me clarify the inversion portion. So if you are talking about probability of recession, my strong recommendation to you would be to look in terms of the New York Fed. New York Fed actually publishes a very interesting probability of default. And according to them, as on 25th, around that, the probability of default was roughly about 25%. So it's not very high in terms of probability of my apologies. The probability of recession was about 25%. So not a very high probability of recession happening any day too soon. They're talking about 25% probability of recession happening by August 2023. So it's still a bit of a space for it to happen across of that. Let me see if I can show you the graphic. The graphic is important. So I would recommend you to keep it note of three things. A, of course, is the probability of recession from New York Fed. Look in terms of the GDP growth from Fed Atlanta, which gives you the nowcasting of the GDP growth. And number three is, of course, in terms of your the job scene. So here we go. So this is from the New York Fed across of them. So if you look in terms of probability of default, it's pretty low at this point of time. Just to give a relative, so New York Fed is nothing but probability is nothing but 10-year Treasury minus 3 months Treasury rates. That's the indicator there. Takeaway to you is that at Silverdale, we believe there could be recession, but it will be shallower, but for a longer period of time. And the reason I say it is this. One of the key components of non-core inflation is energy. Right? And core energy, we discussed about the stickiness of the core inflation. So whether it's wages or whether it's in terms of rent, it will take time before it will come down. So what it basically means is that you will have the inflation to be a bit elevated, but not increasing. So interest rate would need to be elevated, but not increasing. Why? Because if you increase the interest rate further, you'll create more pain. No amount of increasing of interest rate can produce energy, correct? So the point is that you can destroy demand to a point, but not to a point which hurts too much. So today we're talking about economics of the rate hikes. Come 23, we'll talk about politics of rate hike. We already seen the first words coming in the market. You will see it more happening. So just keep that in your view. Next question is when can someone see a recovery in SDF NAVs? What would be trigger a recovery? To be honest with you, nothing happens, it will be good news. so the key point is that if nothing happens, you will see a recovery of the NAV of Silverdale fund improving, finger crossed, much higher than the market as we have historically seen. There's no guarantee, but that's what historically we always seen out there. So the first thing is that if nothing happens, we should see uptick coming across there. And second, of course, that whether any of the positive trigger happens, that could completely change the picture. On the negative side, of course, is China's skirmish with Taiwan. We hope no, but that is what we have to be careful about. And on the positive, as I mentioned to you, for me, there are two. Number one is that if China comes with the mRNA-based vaccination, stop opening up of the lockdowns, there'll be a very positive news. And number two, of course, if the the Ukraine and Russia conflict comes to a point of what we call the freezing the borders. So it will be like a North-South Korea or India-Pakistan, where we will have ambiguity of the borders, but life continues. If any of those two things happen, you will see a much sharper improvement in terms of NAV. But for me, the takeaway, if I were to give you one, would be nothing happens, a good news. Even bad news happens, one quarter and again will be a good news. So on the totality basis, good time to average and to benefit from it, specifically because of the fact that A, in terms of recession, we know fixed income does well. B, currently the bond yields are higher than the earnings yields of the S&P 500, which is very, very great thing to happen and a great opportunity in the sense of the word.
Yeah, Sanjay, we have a very, very interesting question, and you touched upon it a little just now. Should we average SBF at current level and why? And I think this question is really interesting because, like, as you mentioned, there are many pivotal events, and you mentioned there are some positive catalysts that we can look forward to, like China mRNA and so on. So markets have been very sensitive, have been on their toes. And we understand like fixed income is currently at very attractive valuations. So can valuations get as an investor, should you try to time the market? Can valuations get better, more attractive, or should you average at current level? Get in now.
Thanks, Sandy. I think it indeed is a very interesting question. So the point is this: how bad can bad be? In theory, we never know the answer. From a practical point of view, I think we are very close to the peak, and the reason is in front of you. So if you look in terms of the rates, we are already in a situation where we are seeing the interest rate of inflation to be higher for longer. Right? So basically, what it basically means from practical point of view is that we are close to the peak levels which the economy can sustain. I'll give three, four points to corroborate it. Number one, if you look in terms of the number of or percentage of bonds giving you more than 4.5% is the highest since last many decades. Number two is that if you look in terms of what I spoke a couple of times earlier, in terms of the bond yield versus dividend yield, they are higher again since many years. Number three is that from the carry point of view, it's a fantastic carry. So my point is that, look, can you get more? Well, potential is always there. You can never be sure. But do you think current carry is good? It's a brilliant returns you get about that. Let me ask you the other way around. See, we have got almost 13-fold increase in the Fed rates from 0.25% to 3.25%. In 1970s, in Volcker time, the interest rate increased by about 70%, not 300%, 1,300%. So from the percentage-wise, the increase in interest rate now is far higher than even the Volcker's 1970s time. Now take a pause. From here, where do you expect the interest rate to go? At the current level itself, we are talking about a very large percentage of a country's national income being put in terms of the interest cost. To give color to you, the so-called mini budget of UK, you know what it means? At 190 billion pounds sterling, it's about 7.5% of UK's national income. At $33 trillion of US debt, you know what it means? It means the interest rate in US will be higher than the spending US does on social security. So it's not easy thing in terms of talking about further increasing interest rate. As I mentioned to you, today everybody is hung upon in terms of the economics of rate hikes. Next year, we talk about politics of rate hike. How would you justify collecting taxes from the people and paying it to the Fed to bear the interest rates, or the Treasury to bear the interest rates? Politically, it's very difficult. Yo, all the tax you give to me, I'll go and pay on my interest cost. Right? That is when things will start turning around. Yeah. We're talking about in terms of the cost which the people are bearing in terms of the side effects of the increase in the energy cost and the sector there. Look, we're talking about QT, we're talking about rate hikes, and what is happening in ground zero. Germany, unlimited QE for energy, effectively speaking, right? They're getting up to prices bear it. UK, unlimited QE in terms of energy cost. So the truth is this, while on one hand, we're talking about rate hikes, the truth is that at the bottom line, they also understand this rate hike beyond a point is not sustainable, or that the pace of rate hike is not sustainable, and they're already putting some cushions, etc., in order to make it down. What they cannot do is important also. What they cannot do is to tell that the inflation is under control. We are seeing downward trajectory in job market. We are seeing downward trajectory in terms of property prices, because we are not worried about inflation. What we are worried about is expectations of inflation. If you and I believe inflation is going to go up, we are going to behave as if inflation is going to go up. And therefore, what the Fed needs to do beyond anything else is to assure people that they are under control. So they have done sufficiently to prove they are under control. They put a lot of spooks out there, but there's a price to be paid for it. To summarize, what I'm saying to you is that the interest rate increasing 13 times from here is actually possible. So from the upside downside ratio point of view, it's a no-brainer to look in terms of fixed income, and in terms of averaging point of view. Definitely, yes, we should look in terms of averaging across out there. And as I mentioned to you, if you're depending on time horizon, you should at least start, dipping the toes out there and benefit from this 2 quarters of, of the depressed NAVs which we have got it out there, and hopefully the next 2 quarters will be amply rewarded for it.
Do we have any final questions? Okay, the time is 5 p.m. And since we don't have any more questions, once again, thank you, Sanjay, for the very insightful presentation. We hope that we've been able to address all your queries. And some final words: given the heightened volatility, it is easy to get carried away. However, as Sanjay just mentioned in his presentation, extraordinary times can provide extraordinary returns, as evident from the higher yields that you are having today. Therefore, just a final word, this presentation is recorded and will be uploaded to our website for on-demand viewing sometime today or tomorrow. So investors who or our stakeholders can who maybe came in late can watch on demand and anytime review the slides. So should you have any further questions, please feel free to drop us an email at ir@silverdalegroup.com. I will be leaving that email address in the chat for everyone again. And once again, thank you everyone. Have a good weekend and a great day ahead.
Thank you very much. Much appreciate your support. All the best.